everyone, very good evening and welcome to the Money Show. I'm Avan Dabash. Over the next half hour, we will be clearing out all your personal finance related queries. This is an interactive call-in show. If you have any questions, please feel free to dial in on the number that's flashing at the bottom of your screen. If you want to send us your entire portfolio, email us on themoneyshow@etnow.tv. Well, let's get the ball rolling and bring on board our expert who will be guiding us over the next half hour. Joining in on the show today, we have Harshvardhan Roongta, CFP Roongta Securities Private Limited. Harshvardhan, lovely to have you with us on the show. There's so much talk of the Bharat 22 ETF, and that's what I really want to start off with. ICICI Pru MF, they've come out with this further fund offer, if you will, for Bharat 22 EPF. Talk to us about some of the key characteristics of this fund. Is it attractive and should investors look at it?
So, well, Avan, as the word suggests, is Bharat 22. So, it comprises of 22 companies in which the government is intending to disinvest its holding. Yeah. Now, for retail investors, there's a discount of 2.5% which is offered below the NAV. And if you look at the fund management, the expense ratio of the scheme is 0.01%. So, it's 1 basis points. So, that's a huge upside to this, that the expense that you're going to incur for your investments is absolutely the lowest that is available all across investment products. So these are just some of the actual numbers that we're talking about. But if you look at the other composition of the entire portfolio, you look at what the performance of Bharat 22 has been. It's been about 6 months that the NFO had been launched. So if you look at the performance, it's been it's absolutely dismal. You compare it with a large cap fund or you compare it with Sensex, the returns have been absolutely dismal. Secondly, you have to also understand this part, that if you are investing into 22 companies, can I replicate these 22 companies, or do I have a portfolio which also includes many of these 22 companies in an open-ended mutual fund? So, well, the answer would be yes. You would have an open-ended fund which invests into about 40 to 50 companies, and which would have many of these large companies in their portfolio as well. Plus, the upside that a fund manager has is that it's not restricted only to invest in these 22. So, if I put all things together, which is the fund performance has not been good in comparison to Sensex or the other large cap funds since it's NFO, plus there is a restriction of only those 22 companies. Can I also replicate it elsewhere? Yes, of course you can. So what is the real unique feature or the extra benefit that I get when I park my money into this? Nothing really comes to my mind. So what I'd recommend is that you can avoid this particular investment, this option. You can choose other open-ended regular mutual funds would be a far better option. Now, when you look at one category of so-called investors would be to capture the benefit of 2.5% discount that is being offered to retail investors. So typically what happens is you make an application, you enjoy the 2.5% discount, and on the day of listing you sell it off at par. So there's a possibility of a gain of 2.5%, but it's an equity fund after all. And if at all it opens at an NAV which is much lower by 2.5%, then you're not really looking at listing gains as well. So from investors perspective, you can avoid it, and if you want to still bet on the 2.5%, you can try your luck on that part if in case you wish to.
Okay, but otherwise your view is that the features don't really make it a very compelling investment
Absolutely.
at all. That's the view on the Bharat 22 ETF. Well, we've got quite a few viewer queries, so why don't we get straight to it. First up, an email query that's been sent in to us from Amit K. Rathod. He says, I have invested in some mutual funds and I plan to deploy a major savings of this over the next 3 years, mostly for my retirement. Which are the funds that he's currently holding on to? Mirae Asset India Opportunities Fund, Regular Growth Plan, DSP BlackRock Tax Saver, SBI Magnum Multi-Cap Fund, Birla Sun Life Equity Growth, as well as HDFC Balanced Fund. So clearly, despite saving for retirement, he's put his money, it seems, full throttle into mutual funds. The question is, has he made a good selection? Is it good diversification? And has he picked out too many funds, or is it correct?
So well, Avan, if you look at his portfolio, he's got 1 large cap, 1 tax saver, 1 balanced fund, and 2 multi caps. And so this is the market segment that he's investing into, and within each segment, market categorization, if you're looking at a large cap, mid cap, etc., he's got a good scheme that he's picked up within those categories as well. So I don't think there's any need to change, make any changes in his portfolio at this juncture. He can well continue with it. Just that we are not really aware of what is the quantum of investment going into each scheme. So we could even, had we known that, possibly we could have suggested whether he's overboard on a large cap or a multi cap. But in any case, all in all looks good, and he can most certainly continue investing into these.
Okay, so clearly in terms of your diversification, it's a good call. You've invested into fairly nice schemes as well. So stay invested, continue to hold on. And Mr. Rathod, I hope we were able to answer your question. Well, next up, we have Mokshada Chaya, who has sent us an email query as well, and I encourage all of those of you who are watching. Harshvardhan Roongta is with us. If you have any questions, please feel free to dial in. Well, he too is 60 years old. He's a retiree and he's invested in quite a few mutual funds, and he wants your advice as he made the right decision. So there's the Aditya Birla Sun Life Frontline Equity, SBI Blue Chip Fund, the Kotak STD Multi-Cap. He's got HDFC Mid Cap Opportunity as well as Franklin India Smaller Companies Fund. 60 years old, he's clearly put in a lot of wealth in the into a lot of schemes and individual mutual funds. Do you think that he needs to make some chops and changes?
So considering that he's a 60-year-old retired individual and he continues to invest into equity, well, I could highlight that as a good point in his portfolio. The reason being, usually there is a myth that if you, once you're retired, you should not invest in equities at all, or you should not have a high allocation. So I kind of agree with that fact that you might not have a very large allocation towards equity, but not having any allocation to equity could be quite fatal in the long run. I'll tell you why. Because right now, if you're dependent on fixed interest instruments to service your day-to-day living, well, it might look sufficient in today's time, but as inflation catches up, I mean, your expenses per month will be far more than what you're going to generate out of your investments. At that point in time, you'll need to top it up with some kind of corpus that comes in, so that your interest or net fixed interest instrument that is giving you a return needs to go up. So in that possibility, you will need to have some products which will be able to beat inflation. So in this case, he's done a good job wherein he's got equity in his portfolio as well. So in that context, he's doing very well. The second good part about his portfolio is that you've got good schemes that you've got in your portfolio. So there isn't much to complain on the selection of the schemes that you have. Just that because you're retired, I'd like to make one small change in your portfolio. You've got two mid and small cap schemes in your portfolio. So while I advise you to take equity exposure, I would suggest that you do not take exposure or a lot of exposure into mid and small caps. So I make one small change in your portfolio, which is I'd like you to stop the Franklin India Smaller Companies Fund and redirect that amount into a large or a multi-cap fund. One of those can be out of the ones that you already invest into, which is an SBI Blue Chip or a Kotak Standard Multi-Cap. So small, keep just one mid-cap fund, stop the smaller companies and redirect that fund into a large or a multi-cap of one of the schemes that you already have in your portfolio.
Okay, so not too many chops and changes, but nonetheless, that's the advice that Harshvardhan has to give. So far, your selection has been fairly good. You may need to top up your corpus. And do remember, exit the Franklin Smaller Companies Fund, SBI Blue Chip. He also give you the option of the Kotak Standard Multi-Cap Fund. Those could potentially be used as investment options. I hope we were able to answer your query. And do remember, you can call in on the number and get free advice on personal finance and mutual funds. Well, let's take in another query then, and that one is coming in via email as well from Mr. Ashok. He is saying, I wish to invest close to 1 lakh rupees. This is in tax saving funds. Can you please advise some names that he can look at? So why don't you start off by giving us a sense as to what a tax saving fund is, what are the benefits of investing in this? Do you think he's shelved out enough of a corpus to put his money? And for the benefit of a lot of viewers who are tuning in right now, which are some of the best schemes?
So well, Avan, every individual is entitled to invest up to 1,50,000 rupees per annum and save tax under section 80C. So this is clearly an investment that he's looking to make under this particular section, and a whole lot of products are available to be taken, chosen from. So you have a PPF which qualifies under the same section. You have insurance premiums that you pay which also qualify for deduction under the same section. The national savings certificates, a 5 years bank deposit, and etc. So there are a lot of products that combined together put is entitlement to about 1.5 lakhs. Now ELSS is another product which is also a qualifying product for deduction under section 80C. Now ELSS is an equity linked savings schemes. So while all other investments would be debt oriented, a PPF is a debt investment, so is your NSE and bank fixed deposits. Now equity investments are qualify under for benefits under 80C under the ELSS category. So you get the long term benefits of equity investing, at the same time you're saving taxes. Now with a lock-in as a parameter, if you look at a PPF, it has a period of 15 years. If you look at an bank fixed deposit, qualifying for tax benefits is minimum 5 years. So in that context, the lock-in for ELSS is also minimum to 3 years. Though the lock-in period is 3 years, does not mean that once 3 years are completed, you have to remove your money. You can continue being invested in the same scheme, and it just works like an open-ended equity fund then for you. So the advantages over long term is it aligns with your goals. If you are planning to save for retirement, which is say probably 10 or 15 years away, you would want to invest into equity to take the benefit of growth. Now, if you wish to take the benefit of equity at the same time save tax, ELSS works right for you. So in this case, the intent is very good. He wants to invest 1 lakh of rupees. So there are two ways. One is that he picks up that 1 lakh and invests into schemes today itself. The other option would be he takes an SIP, which is a small investment done till March, the end of financial year. Or the third midway is that he wants to invest 1 lakh, may not put in the entire amount together at one shot, but he may split it into 30,000 and invest it over 3 months or 3.5 months. So he could do that as well, which is the midway between an SIP and a lump sum. So what I'd recommend, because the amount is 1 lakh, he could split it into 2 schemes so that he gets the benefit of 2 fund managers, and also he diversifies his investments with the qualifications and the expertise of 2 fund managers.
Okay.
I'll name 2 names for him. I'll give him an Axis long-term equity fund and an IDFC tax advantage ELSS fund. He can pick both of these and just split his amount and invest into both of them.
You have your options ready in some of the tax saving funds. Harshvardhan has gone ahead and intricately explained the advantages of putting your money in this as well. And you can look at the growth option as well if you don't need any cash flow. That's the call coming in. Mr. Mehta, thanks for sending us your query. I believe we have a live caller and our phones are buzzing. From Kolkata, we have Mr. N.C. Roy connecting with us on the phone line. Hi, sir. Welcome to the show. What's your query for Harshvardhan?
Ma'am, actually, I have a query regarding L&T NFO small scale fund.
I'm sorry, I didn't get the name of that. Could you repeat it?
L&T small scale.
L&T, okay.
New issue.
Got it. Okay. What's your question exactly? You want to know if you should invest or have you already put money?
I like to invest 5 lakhs for 5 years.
Into the L&T small cap fund, that's the emerging business fund, correct?
No, NFO that is under now it is a new issue. I think it will be 20 or 22. It will be ended. New issue. NFO.
Okay.
L&T small scale fund. I like to invest 5 lakhs for a 5 years period.
Do you have a goal in mind, sir? Do you have a goal in mind?
Growth option in either emerging business fund or Indian value fund. Which I like your expert opinion.
Okay.
I think it is a dividend option fund. So where I shall put my option? It is Indian value fund or emerging business fund?
Okay.
Value opinion.
Okay. Harshvardhan, do you have any cross questions for him?
Well, actually, Mr. Roy, I haven't got the name of the scheme that you're referring to. If I understand correctly, you're talking about an NFO, which is a small cap fund, and you want to compare this with an L&T emerging businesses fund, I believe.
I believe, yes, sir.
Okay, so that is what you're looking at. So, well, if I also understood your query correctly, you said that you want to invest 5 lakh of rupees or 5 years. I'm not too sure about that, but in any case, my recommendation would, not be relevant to all of that information. I would suggest that you look at a scheme which is already in the offering by any other fund houses. See what happens with a new fund offer. You must understand, is there a extremely different concept that they're coming out with? Is there a unique idea that you're not going to get as an open-ended fund already? So if you have a regular fund which has been in existence for about some time already, why would you want to apply for a new fund offer where you have no idea about what's going to happen with it? So unless there is a very unique idea, you would want to subscribe to it. Otherwise, there is no compelling need to do that. So what I'd recommend, you have a 5 lakh rupees to invest for a 5 or 7 years period, as I understood. I recommend that you go and understand what are the advantages of investing into this particular NFO, if it's compellingly good. If not, then split your money across different market segments. You don't want to concentrate all your money only into a small cap fund. The small cap index and the mid cap index have taken a lot of beating in this financial year, or rather starting the calendar year 2018. So just make sure that your allocations are correct. You want to have a multi-cap or large cap in your portfolio, and then have some bit of mid and small cap. It makes sense. So just don't look at the NAV of 10 rupees or an introductory price of N rupees. It can be a great misguidance. So consult somebody in person and then possibly take a decision.
Okay, I hope, Mr. Roy, we got that question answered. Jitendra Pal Singh is with us from Punjab. Welcome to the show, Mr. Singh. What's your query?
Thank you, ma'am. Actually, my query is, I had invested, I am regularly investing 5,000 rupees in HDFC Mid-Cap Opportunity Fund, regular plan.
Okay.
And I want to invest in another mutual fund. But now I want to know that which mutual fund is perfect for me, because there are a lot of mutual funds which has already grown and which had a lot of volume in itself.
Can you tell us a little bit about your risk profile, your goal, your time horizon?
My goal is about 25 years from right now.
Okay.
I want to invest around in two to three mutual funds, 5,000 rupees, but I want to select proper mutual funds.
Proper it is, and we will give you that advice. 25 years he wants to invest in 2 to 3 names. If you could just suggest some names.
Yeah, so Mr. Singh, right now you are invested into a mid-cap fund, which is an HDFC Mid-Cap Opportunities Fund. It's a very good fund, you can continue investing in that. Now the question arises of how do you allocate the other 5,000 into two different schemes. So the 10,000 into two schemes put together. What I'd recommend is you pick a large cap fund now and you pick a multi-cap fund. A large cap fund will ensure that you have companies that you're investing in are all market capitalization worth 30,000 crores and above. Now, if you have a multi-cap fund, the mandate to the fund manager is that he can invest across market cycles. So he's not mandated to invest only into a large cap, only into a mid cap. He can basically, based on their own research, pick up a company across market capitalization. So what happens is they pick the best of mid cap, they pick the best of small cap, or they pick the best of large cap. So they have that flexibility to create a portfolio accordingly. You have a dedicated mid cap, you can continue with it. Within the large cap, one of your schemes could be a large cap, that could be a SBI blue chip fund. You can invest into that. It's a large cap fund, as I mentioned, and the other 5,000 that you want to invest, a multi-cap fund, you can choose an ICICI value discovery fund. So in this way you would have one large, one mid and a one multi-cap fund, and this portfolio is kind of apt for a 25-year time horizon. However, because all of these are actively managed funds, you will need to keep reviewing the performance. The first time that you can review from now onwards would be another 2 years from now.
Alright, I hope you've taken note of the advice that's come in from Harshvardhan. Tell you what, we're getting lots of your questions and queries. Hold on, we will be connecting with you. For now, we take a quick break. You can email us on the money show at etnow.tv. Do be specific about your time horizon as well as your goals, and we'll help you. But tomorrow, we have a tax special that's coming up. So we will get you all of the fundas of investing, of your tax planning, and help you claim your money. Send us your queries on the money show at etnow.tv. Kuldeep Kumar, partner personal tax PwC India, will be with us. Welcome back. You're watching The Money Show, the only personal finance show where we help you out with your mutual fund, tax and insurance related queries. Harshvardhan Roongta, CFP, Roongta Securities is with us on the show. Well, let's get straight to our segment called the Fund Review, where we take on board one fund and get an advice as to whether it makes sense for investors to look at or not. Today, we're talking in detail about the Tata Retirement Savings Fund. Assets of about 733 crore rupees, and you know it's got names like HDFC, L&T, Yes Bank, etc. Start off by telling us what is your rating on 10, 1 being the worst, 10 being the best, and do you think it makes sense for investors to look at it?
So well, Avan, I would give it a rating of 7 on 10.
Okay.
The reason being, it's a good fund to invest into. It's an hybrid equity fund with about 75% in equity and the rest in debt. Now this has an exit load, and that's kind of the reason I would actually drop the rating to 7 and not go higher, because it has an exit load to dissuade and prevent a person from removing money out of it, which is kind of good and bad both. Just that levying a penalty on an investment when other options are available is quite something that pulls down the rating a little bit. So what happens in this case is, if you've started investing into this scheme and if you redeem within 3 years of making an investment, then there is an exit load of 3%. And if you redeem after 3 years but before attaining the age of 60, then there's an exit load of 1%, which you have to pay. So even if you've invested for 10 years and you want to redeem out of it, you're going to pay 1% out of it, 1% of your corpus. So that's kind of a negative on the fund, but it's actually designed to dissuade you from redeeming out of it. Now it also has one facility which is good. Again, now if you look at the design of the product, it has a good feature which is an automated mode for a person saving for retirement. So if an individual is below 45 years of age and he invests into one of the options, which is the progressive option, which is heavy on equity, Once he crosses 45 and if chosen an auto switch, it automatically switches into a moderate plan, which we're talking about today. So the moderate plan, as I said, is a hybrid fund with about 75% equity, 25% debt. Once you cross 60 and you continue being invested, they will move to a conservative fund, which is a debt fund. So in this case, it moves and reduces your risk as your age increases, and at the same time, post retirement, you have an option of an auto SWP. It's a systematic withdrawal plan. So technically, after you retire, you want some income coming in every month for your survival. So what you could do is you can set up an auto SWP, which is a fixed percentage which gets redeemed out of your fund and comes into your bank account, which can be used by you. Now these are optional features, as I mentioned. You don't need to really go in for an auto switch mandatorily. You can continue being in a moderate plan if you wish to, or a progressive fund. So in all, a good fund, well designed, good performing. It's beating its benchmark and the index, for a consistently since its launch. So good performance, good fund. Just the restriction of cost of exit is something. If a person is well equipped to be disciplined enough, he did not need to go into this fund then.
7 on 10, that's the verdict. Well, Shivakumar is with us on the phone line from Coimbatore. Welcome to the show, Shivakumar. What's your query?
Good evening, madam. I am investing regularly in UTI Midcap Fund 2000 as SIP. Now I want to invest 5 lakhs in mutual fund. Which fund I want to choose?
What's your time horizon?
About 15 years.
Okay.
I want to withdraw that amount 5 lakhs after 15 years.
Okay, 15-year time horizon. Any type of funds, and how would you rate UTI Midcap? Harshvardhan.
Again, a mid-cap fund within the mid-cap category, UTI mid-cap may not be the best performing, but it's something that you can continue to be invested, because over a period of time, which is going to be the best fund, we really don't know. So in that case, it's a good fund, you can continue being invested. Now my concern is about the 5 lakhs that you wish to invest. So Mr. Shivakumar, I'm more keen to know whether you are looking to invest this as a lump sum, or do you have the appetite to bear the volatility in the market, so that in case you're investing as a lump sum, in the short term you could see the fund value going down. But when you invest as a lump sum, you start gaining the power of compounding, because your money gets to work instantly. When you choose an SIP or an STP, which is a systematic transfer plan, you're ineffectively doing a rupee cost averaging. So rupee cost averaging does not really augur well with compounding, though over a period of time you're going to average the market at regular intervals. So first you need to make a choice whether you're willing to invest as a lump sum, and if you're willing to invest, what are the risks associated with it, what is the volatility that you'll have to face. If not, an STP, which is a systematic transfer plan, you could even do that, which is just another way of SIP. So once you're clear on this, a scheme recommendation can be made. Nevertheless, you have a long-term horizon. So in either cases, equity is an asset class that you will need to be in. That's what I can recommend at this juncture to you.
Okay, I hope we were able to answer your query. Well, next up, let's talk about Mr. Krishna's query. It's a pertinent one, so let's take it on board. He says, I'm a first-time investor in mutual funds. I plan to start an SIP of 10,000 rupees per month for the next 10 years. Can you help me build my portfolio? I know everyone must be watching keenly, because a lot of the callers that we're getting also are first-time investors. So what would you advise him to do? How should he allocate his funds?
Yeah, you're right, Avan. So because of the awareness that has been created about the benefits of investing in equity mutual funds or through mutual funds into any other asset class, I mean, we come across a lot of investors wanting to start and begin their investments. So I'd recommend 3 schemes to him for his 10,000 rupees. The first one being an IDFC Nifty fund, the 3,000 can go into that. SBI Magnum Multi-Cap of 4,000 rupees, and ICICI Value Discovery another 4,000. Now since he's a new investor, I've allocated 30% of his money into a passively managed index fund, and other 2 are actively managed. So very consciously I want to make him understand this, that because you're a new investor, do not get attracted to the past performance of mid and small cap funds and start picking those kind of schemes and adding into your portfolio. Understand the volatility that is associated with equity investments. Wait for some time, for about a 2 years time. Understand with this portfolio, you've got a large cap, you've got a multi cap, and you've got a Nifty or passively managed fund in your portfolio. Do not add any mid, small cap, thematic or a sector fund as of yet. Understand the functioning. After 2 years, when you understand what's all exactly happening, you may think of adding a mid or a small cap fund in your portfolio at that point in time. So far, go ahead with the funds that I have suggested to you and begin your journey of equity investments.
And wishing you all the very best. Do remember to review your portfolio. Before we wrap it up, let's hear out Harshvardhan's tip of the day. He says, there is a risk in every investment. Equities have market risks. Fixed deposits have inflation and reinvestment risk. Create a portfolio of both equity and debt that a combined portfolio will look after inflation and market risks together. That's the tip of the day to take note of. Harshvardhan, pleasure as always having you with us on the show. Thanks so much for joining in. For those of you watching, send us your queries on The Money Show at etnow.tv. Goodbye.